Hey everyone, welcome back to Crypto Tax Australia, the channel that breaks down the ATO's rules so you don't get caught off guard at tax time. Today we're tackling one of the most searched questions I get from the community. If I swap one crypto for another, is that actually a taxable event? And the short answer, yes, almost always. But there's a lot of nuance in how it's taxed, what you need to record, and where people make costly mistakes. So stick around, because by the end of this video you'll know exactly how the ATO treats crypto swaps and trades in 2026, and what you need to do to stay compliant. Quick disclaimer before we dive in, this is general tax education, not personal financial advice. Everyone's situation is different, so always speak to a registered tax professional for advice specific to you. Alright, let's get into it. First, let's establish the foundation, because everything flows from this. The ATO treats cryptocurrency as a capital gains tax asset, not as currency, not as money. This has been their position since 2014, and it hasn't changed. What that means in practice is this. Anytime you dispose of a crypto asset, a CGT event is triggered. And the word dispose is broader than most people think. It includes selling crypto for Australian dollars, trading one cryptocurrency for another, like swapping ETH for SOL, using crypto to buy goods or services, gifting crypto to someone else, moving crypto to a DeFi protocol in certain circumstances. So if you swapped Bitcoin for Ethereum last financial year and thought, I didn't cash out, so I don't owe tax. Unfortunately, that's not how the ATO sees it. The swap itself is the taxable event. Okay, so now that we know when a CGT event happens, let's talk about how you actually calculate the gain or loss. The formula is simple. Capital gain, proceeds, minus cost. Base. Your proceeds is the AUD market value of what you received at the time of the swap. Your cost base is what you originally paid for the crypto you gave up, including any fees you paid to acquire it. Let me walk you through a real example. Say back in July 2025, you bought one Ethereum for $5,000. Then in January 2026, you swapped that one TOS Ethereum for 10 Solana when Ethereum is worth $8,000. Your proceeds are $8,000. Your cost base is $5,000. Your capital gain is $3,000. Now here's the good news. If you held that Ethereum for more than 12 months before swapping, you may be eligible for the 50% CGT discount. That would bring your taxable gain down to just $2,500. But if you held it for less than 12 months, the full $3,000 gets added to your taxable income for the year. One more thing people miss. Fees matter. Transaction fees, gas fees, exchange fees. These can be added to your cost base or deducted from your proceeds, which reduces your taxable gain. Keep records of everything. Let's run through some common scenarios you might have experienced and clarify what's taxable. Scenario 1. Swapping on a centralized exchange. Straightforward. You swap BTC for USDT on Coinbase or Binance. That's a disposal of BTC and acquisition of USDT. CGT applies. Record the AUD value at the time of the trade. Scenario 2. Swapping on a DEX, like Uniswap or Jupiter. Same rules apply. The ATO doesn't distinguish between centralized and decentralized exchanges. A swap on Uniswap is still a disposal. You'll need to record the AUD value from a reliable price source at the time of the transaction. Scenario 3. Wrapping tokens, like ETH to WETH. This is a gray area that trips a lot of people up. Technically, wrapping is a swap. You're exchanging one token for another. The ATO hasn't issued specific guidance on wrapping, but most tax professionals in Australia treat it as a CGT event because you're disposing of one asset and receiving another. Play it safe and record it. Scenario 4. Stablecoin swaps, like USDC to USDT. Yes, still potentially taxable. Even if both assets are pegged to the US dollar, they are different assets in the ATO's eyes. If there's any difference in AUD value between acquisition and disposal, which can happen due to AUD-USD fluctuations, a gain or loss has technically occurred. Scenario 5. NFT trades. Trading an NFT for crypto or another NFT, CGT event. The ATO treats NFTs as CGT assets. The gain or loss is calculated based on the AUD market value at the time of the trade. Here's something many people overlook. Capital losses are your friend. If you swap a crypto and the AUD value at disposal is less than what you paid for it, you've made a capital loss. Capital losses can be used to offset capital gains in the same financial year, and if your losses exceed your gains, you can carry those losses forward to future years, indefinitely. So, if you had a rough run in the bear market and swapped some assets at a loss, make sure you're recording those properly. They could significantly reduce your tax bill, not just this year, but in future years too. One important rule. You cannot use capital losses to offset your regular income. They can only offset capital gains. That's a common misconception worth clearing up. Let me be direct here. Your record keeping is just as important as your tax calculation. The ATO expects you to keep records of every transaction, and these records need to show the date of the transaction, the type of transaction, buy, sell, swap, etc., the amount of crypto involved, the AUD value at the time, the exchange or platform used, any transaction fees. How long do you need to keep these records? At least 5 years from when you lodge your tax return for that year. Now, with on-chain transactions, this can be complex, especially if you're active in DeFi or have wallets across multiple chains. The good news is there are tools built specifically for this. Platforms like Coinly can sync with your exchange accounts and wallets and pull transaction history automatically. They'll then calculate your gains and losses and produce an ATO-compliant tax report. I'd strongly recommend using one of these tools if you have more than a handful of transactions. Trying to do it manually in a spreadsheet is doable, but it's tedious and easy to make mistakes. Alright, let's do some quick-fire tips to close out. Tip 1. Use AUD valuations from a reliable source. The ATO accepts values from reputable exchanges or market data providers. Keep screenshots or export your trade history. Tip 2. Don't forget DeFi. Providing liquidity, receiving rewards, yield farming, all of these have potential tax implications. We'll cover DeFi in a dedicated video soon. Tip 3. If you've been ignoring your crypto taxes, catch up now. The ATO has been increasingly active in matching exchange data with tax returns. Voluntary disclosure is always better than being audited. Tip 4. Consider your timing. If you're sitting on a big gain and you've held for less than 12 months, it might be worth waiting until you cross that 12-month threshold to access the 50% CGT discount, if your circumstances allow. Tip 5. Get professional advice for complex situations. If you're running a trading business, actively farming DeFi yields, or have significant capital at stake, a registered tax agent who specializes in crypto can save you more than they cost. And that's a wrap on crypto swaps and trades under ATO rules for 2026. To summarize, swapping one crypto for another is almost always a taxable event in Australia. You need to calculate your capital gain or loss based on AUD market values at the time of the swap, keep detailed records, and report it correctly in your tax return. If you found this helpful, please hit the like button. It really helps the channel grow and get this info to more Aussie crypto holders who need it. Subscribe if you haven't already, and drop a comment below if you have a specific scenario you'd like me to cover in a future video. I read every single one. Catch you in the next one.